Hello, dear friends. My name is Clive Thompson. I'm here in Switzerland, in Crom, Montana. Behind me, you can see an ice skating rink, perhaps. I'm hoping they won't start playing music while I'm talking. And today we're going to be talking about silver and silver miners and what's going on. And the question, which I think everybody wants to know, is silver going to go limit up when the market opens tomorrow, Monday? So today's date is Sunday, 28th December 2025, and the stock markets and the silver COMEX and futures markets will all open up again tomorrow, as will Shanghai Futures Exchange. And we had some amazing trading last week, where silver was trading at a huge premium in Shanghai to the New York COMEX price. And that premium only got wider and wider. And we have to wonder what's going to happen when markets open on Monday. And I'll just show you briefly on my iPad, if I can. Let's just get that up. This, I don't know if you can see that clearly. Hopefully you can. The red line is the second by or minute by minute performance in Shanghai, and you can see the premium widening. And the blue line at the bottom is the near dated future price in COMEX. The difference is nearly $8. But what's basically been happening is that the spread between COMEX prices and Shanghai prices has been getting wider and wider. So, typically we'd expect a difference between the two markets of, or historically it's been 25 cents to a dollar. It widened last week to $3, then to $5, and as of the close of trading on just before Christmas Eve, it was effectively it was $7.82. So we had a near dated future price on COMEX of 77 and 22 cents, and in Shanghai the same ounce of silver was trading at $85.04, difference $7.82. Now silver's been on a roll in the last few months. We saw it reach a price of $40, and we all got very excited when it got to $40 in August. But by September, it had hit $45, and we're getting more excited. October, we hit $50, hitting the all-time record previously. It hit $50 twice before in history, most recently 11 years before, and then once before back in the, I can't remember, probably back in the early 70s when the Hunt brothers were cornering the silver market. So October was $50, a month later, $55. So you see the pattern here. 40, 45, 50, 55. August, September, October, November. So November was 55. And guess what December hit? December we hit $60. But we didn't just hit $60 in December. We also hit $65 and $70 and $75. So we did four $5 moves in December, going from 55, 60, 65, 70, 75, ratcheting up. Will the price be $80 tomorrow, or will it be $100? Well, we're going to try and find the answer to that in this video. But what I can say is the difference between physical prices in Shanghai and New York basically means there is a shortage of silver somewhere, because if there wasn't, the large investment houses would be flying silver from America to China to arbitrage away the difference. So there should be no difference between the two prices. So that tells us that physical silver is currently in short supply. And we know that's the case, and it's been the case for years and years. But of course, the above ground supply is getting less and less. And the reason it's less is that we've had 10 years of declining silver production. And the reason that mine silver production is going down is, for the most part, not totally, but for the most part, silver is produced as a byproduct of other metals mining, and therefore, even if the silver price goes up, it's very dependent on whether the production of the other metal goes up or down, depending on the price. So silver mined production should go up very slightly this year, but it will still be below where it was 10 years ago. And we've had, for the last 5 years, a deficit in terms of consumption. That means consumption of silver in industry and so forth has exceeded the mined supply. So what does that mean? It means the above ground stocks of silver, which are substantial or were substantial, has been getting smaller and smaller. So the silver stocks at COMEX and at the LBMA have been falling for the last 5 years. Um, I'll just give you a little bit of statistics about um, open interest on COMEX and so forth. But before that, I just want to give you a little bit of a warning. I've seen over the last few days a lot of artificial intelligence produced videos about silver. Be very careful when you watch these. I've watched a few of them, and I've noticed that there are a lot of lies. I'm going to call them lies as opposed to hallucinations or imaginations or guesswork. Um, I've done the research, so what I tell you is researched by me, not by an AI machine, which is not necessarily telling you the truth, or maybe there's an agenda to tell lies. It's not that I reach a different conclusion from these AI videos, but I've got real numbers here rather than imagined numbers or made up numbers. So on COMEX, the open interest at the moment is 150,000 contracts of silver. So each contract is 5,000 ounces. So 150,000 contracts of 5,000 is 750 million ounces of open contracts. But the amount of registered silver, that's the silver which can be delivered, is only 113 million ounces. So we've got contracts of 750 million. That's to say people have bought 750 million ounces of silver for future delivery on COMEX, but the amount available to be delivered is only 113 million. Now, in normal times, you'd say there's nothing to worry about, particularly, except that this 113 million ounces is way down from the figure it was 5 years ago. So the deliverable silver has been going down, and presumably the number of I don't have the figure on the number of open contracts, but presumably the number of open contracts has been going up. Now, it's no problem if only 1 in 8 of these contracts ask for delivery. If they do, basically they'll absorb all of the silver in COMEX and there won't be anything left. Realistically speaking, people roll over their contracts. So they bought silver, it comes to maturity, they roll it over to a future date and keep rolling and rolling and rolling. But we've seen a very unusual spike in the last year of people actually demanding delivery of the silver they bought on the future market. So in the event that this 750 million of contracts which have been of ounces of contract which have been bought asked for delivery, well, there's only 113 million which can be delivered. There isn't enough for everybody. So that could be a concern for the major silver consumers. The biggest silver consumers is the solar industry, the solar panel industry. Um, they're consuming about just under 30% of all of the production of silver. And these are companies like First Solar, Jinko Silver, Longi Green, Canadian Solar, Trina Solar, those sort of companies. They're collectively consuming 30% of all the silver which is produced. And why is it a concern for them? Well, if they can't get their hands on the silver, production stops. Bam. So whilst they're sensitive to the price of silver, they're far more sensitive to a cut in production. The next biggest consumer of silver is the technology industry. This would be companies like Samsung, Apple, Nvidia, Intel, Microsoft, and so forth. Collectively, they are consuming, I don't have the figure, but it's probably about 15% of the silver, of the silver production. That's actually, I've got that figure. Yes, it's between 12 and 15% of all production is going in their direction. Um, the the risk for these companies, if they can't get their hands on silver, is high to critical. Critical basically means they can't make things if they can't get the silver. The other consumer of silver are the car companies. These are companies like Tesla, BYD, Volkswagen, General Motors, and Ford. Collectively, not collectively, each of them is producing something, not producing, needs something like 500,000 to 5 million ounces of silver a year for their car production. The amount of silver in a car is somewhere between 0.8 ounces and 1.6 ounces. So the silver price is not a critical component of the manufacturing cost. If the silver price goes from $30 to $100, that increases the cost of your car by $70. So if you've got a $50,000 car, only 30, that was the old price of silver, dollars of that. Now the new price of silver is $100, let's say. I mean, it's not quite there yet. Um, the rising price of silver doesn't affect the price of the car very much. But if the car manufacturer can't get his hands on the silver, the entire production line stops. So with this physical shortage we're seeing in the marketplace, there must be some major worries about from the consumers of silver who are saying, my God, we've been running what's called uh, just-in-time supply chain. In other words, we get our silver just in time. We maybe keep 2 to 4 weeks supply, which is kind of just in time, but actually we now can't get we've just used a week's worth of that supply. We can't get the new week because the silver isn't there. We can't find it. Um, so every every major company which needs to use silver in its every company, let's say, who needs silver in its manufacturing process must be now starting to I don't want to use the word panic, but in a rush to make sure they're going to be able to lay their hands on the silver that they absolutely have to keep the production going. So what will they be doing? They'll be going out and looking to see where they can borrow it and at what price. They'll be looking to see if they can maybe secure an agreement with a mining company to guarantee the delivery of silver on an ongoing basis. But maybe they'll say we don't need 3 weeks supply of silver. We need to have 6 or 8 or 10 weeks of supply of silver in storage, just in case we can't get our hands on silver. So there's a bit of a problem there. Um, just to put these numbers in perspective, I'll give you the full annual mined production. So the annual mine production for 2025 is estimated at 985 million ounces, and the demand in 2025 is estimated at 1,102 million ounces. So that's a shortage of 117 million ounces. Of that demand, they are estimating that 200 to 260 million ounces were going into the hands of investors. In other words, people buying silver. I rather think that with the way things are going, a lot more is going to go into the hands of investors in the coming year. Um, exchange traded funds, they hold 853 million ounces. That's less than a year's supply of silver. Those are the major ETFs. If I take all of the ETFs, it's probably about one one was 1 billion ounces roughly, which is roughly equal to the annual, just a little bit less than the annual demand. So there is some above ground supply. If investors start selling their ETFs, that supply will be available to meet the demand. But obviously, investors are only going to sell their ETFs if they can get a high enough price to satisfy themselves. Just a thing on the price. Now, we've got this gap between Shanghai prices and New York prices over the Christmas period. I'm always a bit wary about prices around Christmas time and the gap between Christmas and New Year, because that's the sort of time when all the senior people in the big firms and the big trading firms go on holiday. So you might have a floor of 50 traders or 100 traders, and they leave behind a skeleton staff of 5, 10, 15 staff. But the staff who are left behind are the ones who draw the short straw. The short straw are the junior traders, the new boys, and they will be left with very, very strict instructions: do not trade, or don't open any positions, or this is your limit. So they're just basically there to man the phones and take orders from the clients and do what they're told, and hopefully not make any mistakes with the fat thumb buying 1,000 contracts instead of one contract. This sort of thing might happen. But what that does mean is that because there's so few traders there, and because they're not the more senior traders, they're not authorized to take positions which can smooth out market movements. So we can, between Christmas and New Year and just before Christmas, have some very large movements which won't be smoothed out because they're not authorized to smooth them out. So in normal times, if a trader comes in and buys 1,000 contracts or something, the big bank can take a equal and opposite position and arbitrage it way, smoothing out the price change so the price of silver moves by 1 cent, 2 cents, 3 cents. But in these narrow times, a single large order might move the price of silver by 25 cents or 50 cents. So that's why I'm wary of the prices I see around Christmas and New Year. It doesn't mean to say that come New Year, when all the big boys are back in the office and the office is fully staffed and now they can take big positions, they don't start to, uh, let's say, smooth out the price movement. So we have seen very violent movements in the price of silver this period, which is kind of something which can happen in thin markets. And we are definitely in a thin market at the moment. So will we see a smoothing down of the price as we go into the new year or not? But now we're between Christmas and New Year. This is the thinnest period. So we might see some very violent moves on Monday. For all I know, we might go to $100. I'm not I'm not predicting that, and this is not investment advice. I'm just saying it is a possibility. But big swings are entirely possible in both directions because it depends if some big trader comes in to do a sell as well. That's entirely possible. Although who in their right mind would be selling when everybody's trying to get their hands on silver when there isn't any? But there's obviously some people out there who just look at price and say, "Oh, it's more than I paid. I'll try and take my profit off the table immediately." It's not necessarily a great move at this time of year because you might not get the price you wanted to do if you wanted to do that. Just running through the margin. Will we go limit up on Monday? Now, limit up would be something like $10 on the price. So that would mean the price going from something like $77 to $87, which is not far off the closing Shanghai price. What was that? That was 70, $85, wasn't it? I forget now. Yeah, $85 in Shanghai. So going from 77 to 87 is entirely possible, given the Shanghai price is already 85, and that gap could close very quickly, especially if the Shanghai price continues upwards on Monday. But COMEX has got a strategy to stop the price rising too far. And when I use the word limit up, I want to stress there is no such thing as limit up anymore. It's a bit of a myth. We used to have what's called limit up in the old days, but what they have is, and I'm looking for the words here. It's some sort of price dynamic circuit breaker. That's it. So the dynamic circuit breaker kicks in if the price moves more than 10% from the lowest point in the last 10 minutes, I think it is. So if the last hour, actually, so if it moves more than 10% from the price in the last hour, then they have a circuit breaker, dynamic circuit breaker, where they stop trading, but they only stop trading for 2 minutes, only 2 minutes to allow traders to adjust their positions, and then it restarts with a new high and low. So any price change which is more than 10% from the previous high down, or more than 10% from the previous low up, will create another circuit breaker. So you could get multiple circuit breakers, but those circuit breakers are only 2 minutes each, and trading should continue. But one of the things that COMEX can do if they find the price is rising too fast, and rising too fast would mean the shorts are getting in trouble, and trust me, the shorts probably are in trouble at the moment because they're having to meet margin calls. The margin on COMEX futures was silver futures was 22,000. I'm telling you that on Monday they're going to raise that margin. It will go up. So I'm guessing they're going to put it up to $25,000 per contract. Now, at $100, a contract would be worth what would it be worth? $500,000. Yeah, you've got 5,000 ounces multiplied by 100. That would be $500,000. If they put the margin up to $25,000, that means for every $500,000 you trade, you've got to have $25,000 of cash or treasury bills with COMEX as basically security. Put another way, you can trade 20 times your equity, you will be able to at that level. Obviously, that's a very leveraged position, and they might, if the markets start moving even faster than we've seen, go higher than $25,000 as a margin on silver. But what happens when you increase margin? Well, there are some people who can't come up with the extra cash because you've got to come up with the extra cash straight away, the same day. And if you can't come up with the extra cash, you only have one choice left, and that is to reduce your position or completely unwind it. So by putting up the margin, that brings out forced sellers, not because they want to sell. I mean, if they got a futures contract and they're long, they're obviously expecting the price to rise, but they have no choice. So I think on Monday, it's very likely we will see an increase in the margin requirement from $22,000 to $25,000. Just my guess, it could be another number. And that will bring out a small number of forced sellers, which would, in normal times, bring down the price. But we don't know that will happen because there's a huge interest in silver. We've got this physical shortage going on, which actually might mean that even though there'll be net selling from the futures, people are long futures, the silver price could still keep going up. Let's see what else I've got to tell you. Oh yes, I want to tell you um, about one other thing which is going on, which is quite important. From the 1st of January, China will bring in export restrictions. So what that means is that there'll be a permission process required, and it's very complicated and very restrictive for silver to be exported from China to the West. Now, silver has in the past been exported from China to the West. In 2024, they exported 60 million ounces. In 2025, it's estimated that they will have exported 40 million ounces. The figure is likely to be a lot less in 2026 due to these export controls, which come into force immediately on the 1st of January. You can hear a duck quacking in the background there. So what's going on in China? Well, basically, they might call it export controls, but really it's a blockade on the export of silver, which is a strategic metal, and they're securing the supply for the domestic solar industry, which has been consuming more every year, and for the electronics industry, which has been consuming more each year. So, just if I can summarize now the key points we've got for silver going forwards, we've got physical silver becoming more scarce, harder to get your hands on it. But it is out there. There's plenty of it out there, but it's just getting, the sellers, let's say ETF holders, are becoming less willing to sell their silver. We've got a disconnect between the price of physical silver, i.e., what you pay if you pick it up, and the paper silver. So when you're seeing one price, $77 in New York on COMEX, try and buy a physical bar, 12.5 5,000 ounce bar or whatever at that price. You probably won't be able to. I'm hearing anecdotally that people are paying very high premiums to lay their hands on physical bars, even the large bars where there should be almost no premium at all. Now, I can't prove that because I haven't rung a dealer myself. But yeah, I hear there's a huge premium. Now, here the premium is bigger than it's ever been. We've got the industrial consumers, solar companies, car companies, electronics companies, facing a supply risk, which means they will be reassessing how much silver they have to keep in stock and reassessing where they're going to get it from and if they can get it from. And some of them might be in a little bit of a panic state to say to the people in charge of getting supply, work over the Christmas weekend. We want you to find it to make sure we don't run out, whatever happens. We also have a potential, and it's a very low risk, I want to say, but it's a banking risk. Some of the major bullion banks, some of the major banks, let's say, I don't call them bullion banks, but some of the major banks are traditionally short silver on COMEX, sometimes to the tune of hundreds of millions of ounces. And depending on how fast the silver price moves and how high it goes, they will be having to meet margin calls, and they will have limits as to how much they're prepared to lose. But in a certain extreme situation, an unlikely situation, I might add, it could well be that they suddenly find they can't come up with all that margin in enough time, and there's a bit of panic. Then all their counterparties start to panic about their derivative positions on forex, on stocks and indexes and other things, and we could have some sort of domino effect. Now, again, it's not investment advice. I think it's very low risk, but don't exclude it. But if you hold the physical silver, why do you worry? We've got the export controls coming into China, so that's a tightening of supply in the West. And I'll just finish off with one last risk you need to be aware of, and that is the risk of being forced to accept cash settlement. In the event that prices are going too wild and the shorts are going to lose too much money, there is a risk that the exchanges, the futures exchanges, go to cash settlement at a particular price. Let's call it $77 an ounce. In other words, let's say you're a large car company, you think you bought your future silver production by buying futures on COMEX, and you're thinking you're going to get delivery, but unfortunately the shorts are going to lose too much money. So they say, sorry, because of the shortage of physical silver, we don't have enough. And I just mentioned there's only 113 million ounces worth versus 800 million ounces of contracts out there. So 800 million trying to be bought and only 113 to deliver. So if all that gets demanded to be delivered, there won't be enough to go around. They might have to basically close the market temporarily, or say everyone gets cash settlement, and you get cash settlement at the last known price, call it $73. But now you're a large car company, you need to get your hands on that silver. You thought you were going to get it. Now you're not going to get it. Now you have to go and buy it somewhere else, except nobody's going to sell you silver at $73. It's going to be $200 an ounce. Now, it's not, again, because silver is such a small component of the manufacturing process of most things, you're kind of insensitive to the much, much higher price. But the point is, you have no choice because you have to keep the manufacturing going. So you have to lay your hands on that silver through hell or high water, no matter what the price is. So we might suddenly find that all the consumers of silver, the manufacturing companies, suddenly decide over this weekend and early January, gosh, we've got to do something about this. We didn't realize, we thought that this just-in-time supply chain was always going to work the way it's always worked. And suddenly there's a fear setting in, maybe it won't. So what if we can't get our silver? We have to shut down production. So there could be this sort of panic developing, and then every company gets into a race against each other to secure their supply, and we get a runaway price. Again, I'm not forecasting it. It's not a financial advice, but it's a scenario which might happen. So that's just to give you a painting of where we are on silver at the moment, the way I see it. I'm certainly not selling any of my silver or silver mines at the moment. One thing I would say is that I've done some maths on a few mining companies, and in the event that the price of silver, even if it goes back to $50 or $60, let's say I used a figure of $50 for the purpose of this exercise, but even if silver goes back to $50, a lot of these silver companies, I haven't done them all, I did the few I did, all of them show that next year, even at $50 average price, their profits will be significantly higher than they have been. And even if you take a price earnings ratio of 10, which is very modest, don't forget the industry average is about 26 times, but even if you take a low price multiple of 10 times, the share price would be 50, in cases that I looked at, sometimes 50% higher than today's price. And I'll just give you an example. I won't say the name of the company because I think that will be a separate video to talk about some silver companies. But in one company I looked at, the cost of mining the silver, the all-in sustaining cost is $13.94. In the last 3 months, the last reported quarter to September, they sold it at $33.89. So digging it up for, let's call it round figure 14, selling it for round figure 34, $20 profit per ounce of silver. But Now the silver price is, let's call it 74, just for simplicity. Well, that's $40 higher. So their profit goes per ounce of silver goes from $20 to $60, 3 times as much profit. So based on the last quarter's profit, if the silver price is sustained at 73, they're going to make 6 times as much profit in the first quarter of 2026. That's just one company I was looking at. And then if I take that number, stretch it out over the full year and multiply it by 10 for a price ratio of 10, I get to a share price which would be many multiples of today's price. I'm not going to say how much, and I won't say the name of the company because I'll do that in a separate video. My name is Clive Thompson. At the end of this video, if you'd like to hear more about the kinds of things I talk about, I talk about stocks, I talk about bonds, I talk about gold, I talk about silver. I also talk about crypto sometimes. My objective is to give everybody some level of financial education about what's going on in the market. It's not supposed to be investment advice. You shouldn't do what I do. I do everything for free. So if you want to write to me and ask a question, I'll try my best to answer it. You can do that. You can write to me via the comments, and I'll answer them only in the first day at the best, at the worst. LinkedIn, I reply to almost every comment if I can. I might miss the odd one or two. And if you want to have a consultation with me, that's free of charge too. I can't do everybody, but I might pick one or two people who've written asking for a consultation. You might have a couple of weeks wait, but I have a diary full of consultations. No charge for that. I don't want any email addresses. I don't want any passwords or usernames or subscriptions. I don't have any subscriptions to sell. So feel free to talk to me if you need some. If you need to know if your direction of travel when it comes to investing is the right direction of travel, but I don't give investment advice. Please don't ask me, Clive, how should I invest my money? Because I can't tell you that. I'm not your investment advisor, but I can help you feel whether you're on the right track and how you should look at things going forwards. So if you like this sort of video and you want to hear more, like, subscribe, do go to my website. If you want to see some interesting things, there's a few interesting things on my website will be developing over the coming months, but there's quite a lot of interesting stuff there. Somebody wrote to me yesterday and said, I loved your story. One of the funniest stories I've ever seen about how to make a Monte Carlo sandwich. So it wasn't just investments, okay? Monte Carlo sandwich. I think the title was How to Make a Monte Carlo Sandwich While Trading Bitcoin at the Same Time. All a bit of a joke, really. My website is clivethompson.com. All one word, clivethompson.com. So feel free to go and look there. There is an offer there for getting a free service, which is called Simply Wall Street. No email address needed. Oh, sorry, you do need email for that bit, but no credit card needed. Free forever, limited to 10 stocks and one portfolio. But there's a premium version if you want more than that, with a big discount, provided you use the same link on my website to get it. Yeah, so clivethompson.com is my website if you want to look at more. Don't forget to subscribe. Don't forget to like. Thanks very much, everybody. Speak soon. Bye-bye now.